Hello everyone and welcome to our new lecture series. Today we are going to dive into an essential accounting standard IFRS 13 which focuses on fair value measurement. This standard is crucial for your understanding, not only for your exams but also for your professional career ahead. In fact, the importance of this standard at academic and practical level cannot be overstated. Now, why is IFRS 13 so significant? Well, fair value measurement is a concept that you will encounter repeatedly in various financial reporting scenarios, making it a cornerstone of modern financial accounting. The principle and guidance provided by IFRS 13 are relevant in multiple contexts, whether you are dealing with asset, liabilities or equity instruments. And as we proceed, I want you to keep in mind that mastering this standard will equip you with the necessary tools to tackle with a wide range of accounting challenges. So please make sure to pay close attention, as this will be a key part of your preparation for both exams and real-world application. Is everyone with me so far? Great. So let's begin. The accounting standard we are focusing on is IFRS 13 and its central theme is fair value measurement. My friends, I always say that to truly understand any accounting standard, you must first understand its name. The name of a standard often reveals its core purpose. If you understand the meaning behind the name, you are already halfway to understanding its application. On the other hand, if the name remains unclear to you, no matter how much effort you put in, the standard itself will remain mysterious. So let's start by understanding the name of our focus today, that is IFRS 13 fair value measurement. The key term here is fair value. Now, this is not the first time you have encountered the term fair value. In fact, you have come across it numerous times as you have studied other accounting standards. For example, in IS 2, when dealing with inventories, you would have encountered the concept of fair value in terms of estimated selling price and the market values. Moving forward to IS 16, which deals with property, plant and equipment, fair value comes into play within the revaluation model, where assets are measured at their market value. Similarly, IS 38 on intangible assets, IS 19 on employee benefits, and even IFRS 9 on financial instruments all involve discussion around the fair value. Standards like IS 36 dealing with impairment of asset, and IS 40 and IS 41 which handles investment properties and agriculture respectively also revolve around the fair value measurement. The reality is that if we evaluate all the accounting standards used in today's financial reporting, we would find that modern accounting is deeply enrooted in fair value concept. Fair value is not just a passing reference. It is the foundation upon which most of the accounting standards are built. IFRS 9 in particular has pushed the boundaries of fair value application to its limit. Given that nearly all current accounting standards are linked with fair value, it becomes clear why IFRS 13 is such a critical standard. It serves as a backbone of the fair value measurement across the board, making it necessary for anyone looking to master the financial reporting. Now, let's address the first question that might have crossed your mind as we dive into IFRS 13. That is, why did IFRS 13 come into existence? When we have been hearing about fair value in nearly every accounting standard, why was there a need for a separate standard just for fair value measurement? What makes IFRS 13 so important? My friend, this is an excellent question and one that will help you grasp the significance of this standard. So let me explain. You see, before IFRS 13 was introduced, the concept of fair value was indeed prevalent across various accounting standards. Almost every standard mentioned fair value at some point, whether it was IS 2, IS 16, IS 38, IS 19 or any other standard. However, there was a major issue. Each of these standards provided its unique guidance on what fair value meant and how it should be calculated. For instance, one standard might have said fair value means the revalued amount, while the other might have stated fair value means the net realizable value NRV. Some standard would define fair value as fair value less cost to sell, and other would offer another definition. This lack of consistency created a significant problem in financial reporting. Imagine preparing financial statement where each asset or liability's fair value is calculated differently based on standard you are applying. What would be the result? Inconsistencies across the board. Even though the concept was the same, that is fair value, the application varied so much that it created confusion and complexity in the financial statement. This inconsistency not only affected the reliability of the financial information, but also made it difficult for the stakeholders to compare financial data across companies or even across time periods within the same company. Recognizing this problem, the International Accounting Standard Board, that is IASB, introduced IFRS 13. The primary goal of IFRS 13 was to remove these inconsistencies. It was not about introducing fair value accounting that was already in place. Instead, IFRS 13 aimed to standardize how fair value is defined and how it should be measured across all relevant accounting standards. In other words, IFRS 13 does not tell you when to measure fair value or which assets or liabilities should be measured at fair value. That's the responsibility that lies with the respective accounting standards. What IFRS 13 does is provide a unified framework for how to calculate fair value when you need to apply it. By bringing all fair value guidance into one standard, IFRS 13 has eliminated the cross-border inconsistencies. Now, whether you are applying IS 16 for property, plant and equipment or IS 40 for investment properties, the method of calculating fair value remains constant. So in summary, IFRS 13 was born out of necessity to bring uniformity, clarity and comparability to fair value measurements across all accounting standards. This standard ensures that when we talk about fair value, we are all speaking the same language, no matter which standard we are dealing with. Does that make sense? Good. Now, let's dive a bit deeper and talk about the core reason why IFRS 13 needed to be introduced. You might wonder that before IFRS 13, how fair values were calculated or what led to the need for this standard. Let me explain it to you in the simple term. Before IFRS 13 came into existence, different accounting standards had their own way of defining and calculating fair value. Each entity interpreted these standards according to its own understanding, according to its own circumstances. This led to a scenario where each company would calculate the fair value of an asset or a liability from its own unique perspective. For example, imagine two companies. Let's call them Company A and Company B. Both the companies own the exact same machinery. It's the same brand, same specification, everything is identical. However, because there was no standardized approach to calculate fair value, Company A might value the machinery differently from Company B. This could happen because each company was using its own method, influenced by its own assumptions and the market condition. And what was the result of this? We ended up with something called entity-specific fair values. Instead of having a consistent value for identical asset across different companies, we had values that were specific to each entity. And this created a significant problem in financial reporting, that is, lack of comparability. When investors, analysts, or any stakeholder look at the financial statement from different companies, they would see that the same type of asset were valued differently. Even though the assets were same, their reported fair value varied due to the different methods and assumptions used by each entity. This lack of comparability made it difficult to make informed decisions because the information was not consistent, because the information was not reliable. And to address this problem, the International Accounting Standard Board decided to step in and introduced IFRS 13. The main goal of IFRS 13 was to eliminate the inconsistencies that arose from having different fair value calculation. ISB decided that it was time to unify the approach to fair value measurement across all accounting standards. IFRS 13 does not interfere with other standards in terms of when to measure fair value or which items should be measured at fair value. Instead, it provides a consistent framework for how to measure fair value. It tells us that when it's time to calculate fair value, every standard will refer to IFRS 13 for guidance. This way, every entity is now required to calculate fair value based on market-specific conditions rather than their own entity-specific assumptions. So, what's the key takeaway here? With the introduction of IFRS 13, entity-specific fair values are now a thing of the past. We have moved towards a system of market-specific fair values. This means that when fair value is calculated, it should reflect the value that would be determined in the market, not just what a single entity thinks it's worth. Now, when someone asks you what's so special about IFRS 13, you can confidently say that it marks the end of entity-specific fair values and the beginning of a globally consistent market-specific approach to fair value measurement. This shift ensures that financial statements are more comparable, reliable, and useful for everyone who relies on them. Is that clear? Great. Now, let's move on to the next part where we will discuss the story behind the creation of IFRS 13. It's important to understand the why behind this standard to fully grasp its significance. In the world of accounting, every country has its own regulatory body. For example, in Pakistan, we have the Institute of Chartered Accountant of Pakistan, that is ICAP, which oversees accounting standard and practices. Similarly, each country has its own set of rules and regulation tailored to its local business environment. However, when we shift our focus to the global stage, there are two primary accounting bodies that have a significant influence worldwide. One is International Accounting Standard Board, that is IASB, which is responsible for creating International Financial Reporting Standards, that is IFRS. And the other is Financial Accounting Standard Board, that is FASB, which sets the accounting standard in the United States, known as US GAAP. Now, why is this important? Because even though many countries, including those in the subcontinent and Europe, follow IFRS, the United States, that is the world's largest economy, follows its own set of rules under US GAAP. The US economy is so enormous with the most significant investors, innovation, and the business activities centered there. It is a massive force in the global economy. But here, the challenge is, while most of the world was on the board with IFRS, the US stuck to its own accounting standard. This created a major divide in the global financial reporting. For instance, if a multinational operates both in US and Europe, it would have to prepare its financial statement under two different set of standards, IFRS and the US GAAP. And this lack of consistency made it difficult to compare financial statement across borders. Recognizing this problem, the IASB and FASB decided to work together to harmonize these standards through what is known as Convergence project. This project aimed to bring the US GAAP and the IFRS closer together, eventually unifying them into a single set of global accounting standard. The goal was to eliminate the difference and create a uniform system that would work for everyone, making financial statements globally comparable. One of the significant outcomes of this convergence project was the development of IFRS 13. Before IFRS 13, different standards had their own definitions and methods for calculating fair value, leading to inconsistencies and confusion. But with the introduction of IFRS 13, both IASB and FASB agreed on a single set of guidelines for measuring the fair value. This means that now, both in the US and globally, fair value is measured using the same principle, leading to increased comparability and consistency across financial statements. So why was IFRS 13 necessary? First, to eliminate the inconsistencies that existed across different accounting standards regarding fair value measurement. And second, to improve comparability by ensuring that everyone calculates fair value the same way, based on market-specific values rather than entity-specific one. And finally, it was a crucial step in the convergence project, bringing the US and the rest of the world on the same page when it comes to the fair value measurement. This is why IFRS 13 is such a fundamental standard. It represents a unified approach to fair value that has been accepted globally, bridging the gap between the US GAAP and the IFRS. Alright my friends, before we dive deeper, there is a crucial point I need to emphasize. So please note this down. The primary function of IFRS 13 is to define what fair value is and to provide the guidance how to measure it. That's it. IFRS 13 is all about how you measure fair value, not when you do it or how you account for it. Let's break this point a bit more. Imagine IFRS 13 as a rule book for how to determine what fair value actually means and the methods you use to measure it. However, IFRS 13 does not tell you when you need to measure the fair value or how you should record it in your financial statement. Those instructions come from other relevant accounting standards depending on the context of transaction or the asset or liability in question. For instance, if you look at IS2, that is inventories, it provides guidance on calculating the net realizable value NRV of inventories only when there is evidence that inventories might be impaired. Here, IS2 will tell you when to apply fair value and how to account for any impairment. But it will refer to IFRS 13 for specific methods to measure the fair value. Similarly, IS 16, property, plant and equipment, discusses fair value in the context of revaluation model. It tells you that at each reporting date, if you are applying the revaluation model, you need to ensure that the carrying amount of your asset does not differ materially from their fair value. Again, IAS 16 guides you on when to perform the revaluation, but it looks to IFRS 13 to define and measure the fair value. Similarly, another example is IFRS 9 financial instrument, which requires you to measure certain financial assets and liabilities at fair value at every reporting date. IFRS 9 will tell you when to calculate fair value and how to recognize the changes in fair value, whether in profit and loss or other comprehensive income. But the calculations method, those come from IFRS 13. So to sum up, IFRS 13 is your go-to guide for understanding how to measure fair value, what inputs to use, what methods to apply, and how to approach different type of assets and liabilities. But it's the other relevant accounting standard that will tell you when to apply fair value and how to account for it in your financial statements. This distinction is crucial because while IFRS 13 ensures consistency in measurement, the timing and accounting treatment are dictated by the other accounting standards. Does everyone get that? IFRS 13 is like a toolkit. It provides the tools you need to measure the fair value accurately and consistently. But it's the other standard that will tell you when to open that toolkit and how to use that tool within it. Today, we have explored the introduction and background of IFRS 13, focusing on why it was necessary and how it brought uniformity to fair value measurement across different accounting standards. In our next lecture, we will take a closer look at what fair value really means and how it is defined under IFRS 13. I hope this session has provided you with a solid foundation. Thank you for joining, and I look forward to see you in the next lecture. Thank you.